Hi guys, it's Ted here, my fellow enthusiasts. Let's get started on common quantitative modeling errors. This is a video for the beginner pillar of the cohort. We will be covering 15 common quantitative modeling errors, which are diversified in four phases of strategy development. The first being data sourcing and pre-processing, then model development phase, then backtesting phase, risk management, and live trading. So, in actual quant firms and hedge funds, there will be departments for each of these phases. There will be a specific department full of guys handling data sourcing and pre-processing, then entire hypothesis building and model development phase, then backtesting phase, then an entire department of traders who look out for risk management, live trading. And there will also be a department coding the entire thing and ensuring that the execution speed matches the expectations. So let's get started with phase one, data sourcing and pre-processing. The first mistake that you might make in your quantitative models is survivorship bias. So what is survivorship bias? Let's take S&P 500. S&P 500 has 500 stocks. So if you take data from 2005 to 2025, if you're downloading your data right now in 2026, you are only taking the constituents of S&P 500 which exist right now in S&P 500 in 2026. You are ignoring all the stocks that have been delisted, namely, let's say in 2008, Lehman Brothers, right? They had a severe crash and it got delisted. So what survivorship bias does to your model is it only takes the winners, right? It doesn't consider the stocks that failed, that went, the companies that went bankrupt. Let's say you create your entire parameters, you create your entire model, and you realize you didn't include companies that got delisted, let's say Lehman Brothers, and your model was already in Lehman Brothers, in a position, long position Lehman Brothers in 2008. So that will create a really big drawdown and will decrease your CAGR. So this is the chart. As you can see right here, the true market that include bankruptcy has a much lower return and a bit of better drawdowns than the survivorship bias, the green line, right? So let's talk about the next mistake that people make. It's called look ahead bias. And look ahead bias means that your model is using information or data in a study or simulation that wouldn't have not. Let's skip for this. Let me give you a real life example, right? So what look ahead bias does is that it will create a sort of data leakage. Well, data leakage or feature leakage is is like a little sibling of look ahead bias. But what look ahead bias does is, let's say again you have a data set of 2005 till 2025 or 20-year data set. Look ahead bias includes, it makes your model have the entire thing ready. So your model will already know what, let's say your model is taking a trade in 2006, but it will already know that there is going to be a crash in 2008, there is going to be a crash in 2020. So that creates a sort of leakage that your model already knows the future, whereas in reality your model will not know the future, right? This is look ahead bias. To make it even easier for you to understand, it's like you're giving a student who is appearing for an exam in 3 days, and you're telling that the student to prep for the exam, but you're also giving the student the question paper being the data set, right? So it's overfitting. It knows the question paper, it will plan accordingly, it will prepare accordingly and give you the best possible results, right? So this yeah, right, using the closing price of the current day, we will include this in look shift error. That's the next mistake, right? So trading look at bias in trading signals, it's very common that you might forget to check for this, you might not audit for this. But let's go into more detail of look ahead bias. The most ubiquitous error in vectorized backtesting is, let's say your model created a buy signal on Bitcoin on 13th of Jan, right? But what your model will do in shift error is the signal was generated at the close 94,780, right? Yeah, it created a signal that time at the closing of that day. So what, taking common sense into place, the entry should be done on the opening price of the next day. Or maybe if you are a crazy guy, or if you are really into rebalancing or all, it might take a trade on 14th of January, but 2 hours later from the opening, 3 hours, 6 hours later, but still it should take the trade in the next day, right? No. What shift error of look ahead bias will do, it will take the trade. It created a signal at the end of 13th Jan, but the model will assume that the entry was already done on the opening of 13th of January, which created the look ahead bias. And it has a devastating effect on the model. I will show you. Wait a second. Yeah. So the shift error is t into t, whereas the correct logic is t minus 1 into t, or you can say it as t versus t plus 1, right? So as you can see, your model might even not be outperforming buy and hold, whereas your shift error will be creating 800% returns and a sharp of 10 and maybe CAGR of 200%. That's unrealistic, right? So let's talk about the next one: mishandling corporate action, stock split, and dividends. Yeah, a lot of the data vendors, they will not give you the adjusted price. What is adjusted price? I will tell you that as well. So equity stocks, sometimes they grow through splits. Let's assume Apple stock. Here there is an example of Apple stock. Let's assume Apple stock was trading at $400, right, for one stock, and then a split happened in August 2020. Now after the split, because it was a 4-for-1 split, the four shares will be like that one share will be divided into four shares of 100 each, right? So if you don't have the adjusted price of stock splits and dividends, the model, if the model was already in a position before August of 2020, it will see a severe crash. It will see that, right, there was a phantom crash that didn't actually happen. There was stock split, right? So this right here, 400, 450, the Apple stock was trading at, and then all of a sudden crashed. But it didn't actually crash, right? This is a phantom crash. We have to ensure that we use adjusted stock prices. So again, now this is a favorite of mine: poor treatment of outlier fat tails. In financial markets, there usually is not a Gaussian distribution. What is a Gaussian distribution? It is something like this, right? I will show you it in the diagram as well. So this is a Gaussian distribution. The blue line is a normal distribution, whereas the 1987 Black Monday crash, it was a 20 sigma event, right? It was practically impossible. I will give you an example as well. I was reading maybe a year ago about a quant firm that tried to replicate Renaissance technology, but they failed to treat outliers, fat tails. So, if I remember correctly, they were highly leveraged on a country that country will not default on their debt, but that country did default on their debt, and since they were highly leveraged, there was an immediate drawdown. They were wiped out, liquidation, margin calls everywhere, right? Now, the fat tail, these are the extreme events. These are probabilistically impossible, but still might happen in some cases. Like there might be a World War III, there might be some other geopolitical reasons, or anything could be there, right? Like 2020, was COVID-19 expected by people? No, right? Exactly. Now, coming on to phase two, model development phase, overfitting and p hacking. P coefficients is basically where you uh, think that there is a predictive power and you're overfitting to that predictive power. So let's assume during 2005 to 2025, you are optimizing simple moving averages, right? And after your optimization, you get to know that a 26 and 36 combo of SMAs gave the best possible returns. But if you use that combination for your future trades, it is based on an assumption that that same combination will work out in the future, which might not be true, right? It might not work out in the future. Now this is a clear case of overfitting. It is very common in machine learning, neural networks, right? So explaining you the graph as well, the historical data is the black points. It is clustering near the signals, and it is random as well. The overfit trading model will almost correctly take all trades, whereas an underfit model only might take two or three correct trades. And this is where we have to make sure that our model is robust. And the robustness check and the optimization, we will go through that later as well. Now, continuing on to multicollinearity. So, what is multicollinearity? It's basically a fragility test. It's like making your model really fragile. So let's assume you were testing SMA. It's the example is of SMA as well. Assuming that your optimized parameter was 50 SMA, and you think they are 50 SMA, let's use this, it's a robust parameter, right? But you have to do a fragility test that if that same length is increased to 55 or decreased to 55, does it significantly reduce returns or increase the drawdown or decrease the sharp? Then yes, you are using highly correlated predictors. This makes the coefficient estimates unstable and extremely sensitive to small changes in the model. So small changes, 50 SMA, instead of that you use 49, 51. That's a small, damaging the model's reliability out of sample. This is the graph right here, heat map graph. Now talking about the non-stationarity, it's a very common thing in I have a great example for non-stationarity as well. So let's assume, I will explain you stationarity first. Let's assume you are a ML guy working in a hospital, right? You have a data set that people who are aged 1 year olds till 120-year-olds, they have a heart attack. Now, a 5-year-old guy might have a heart attack, or a 50-year-old might have a heart attack, or a 70-year-old might have a heart attack. But that 50-year-old had a heart attack at 50, right? It's a stationary point in time, right? If he again has a heart attack after 5 years, now the variable changes to 55. Again, it's a stationary point, right? But in stationary market, in financial markets, let me show you this. Let's take the example of S&P 500 this time around. Let's take 1 month data. So in financial markets, you if you think if you think with common sense, this is common sense. All of these mistakes are really common sense. You just have to think hard about it. But let's say that a $10 move in 2025 signifies entirely different thing, and a $10 move maybe in 2018 or a $10 move in 2010 are entirely different. Why are they entirely different? Because of macroeconomic factors like inflation is there, GDP growth, unemployment rates, purchasing power parity. Let's assume you could get a you could get 5x in 1960s for $1. Now you might not even be able to get one egg for $1, right? Because the purchasing power parity changed and the volume levels change, the retail participation, the liquidity in the market changes. So at each point of time, you can't just assume that this, whereas this are the common retail chart traders just assume each candle has the equal weightage and signifies the same thing. But it's not true. The data is non-stationary, it's a geometric random walk, whereas you have to create a stationary data, especially for machine learning models. We will be going through that in the advanced modules. Now, why does this happen? Financial time series are rarely stationary, meaning their mean and variance change over time. Whereas many statistical models, machine learning models, assume that the data is stationary, which is entirely not true, creating a fake drift upward over time or creating a fake trend. So this is the graph trend, non-stationary data, and this is the stationary log returns. So now talking about future leakage, again, this is a part of look ahead bias, but it is a very important thing to look for. I will take the same example for this 2005 to 2025, right? Data leakage is again your model has the entire data set, it's a student, and it's like the model already knows that what's going to happen in the future. But when you run the model into live market, it doesn't know the future because it does not have any statistical edge or predictive power, right? Now coming on to phase 3, ignoring transaction and slippage. This can be a devastating blow for lower time frames. By lower time frames, I mean the lower time frames a retail trader can trade on, being 1 minute, 5 minute, maybe seconds time frame as well, up till 15 minutes or 30 minutes time frame. So let's say your strategy takes a trade about 100 times a day, and you're not including the commissions. For each trade, let's say you are making 50 cents, or let's say $1, but your commission is zero point 0.1. The commissions, if you're not considering it, it's eating away your profits. And there is bid ask spread, so there will be a few pips spread between the buyer and the seller. So if you are entering the trade at $100, you're punching in the trade at $100, it might get executed or 100.1. That zero point 0.1 will be a loss instantly when you enter the trade. Bid ask spread is their market impact. If the liquidity dries down, there will be a huge slippage. The price, the bid spread will increase, bid ask spread will increase, right? So it especially has a drastic effect on HFTs and lower time frame modeling. As you can see, the gross return with no cost will look brilliant on paper, but once you include the net returns, it will be barely profitable. Now, coming on to assuming infinite liquidity, market impact bias. So right now you might be taking trades with $20,000, right? Almost any developing and developed market to will be able to accommodate that $20,000 trade without a lot of issues. But the issue comes in when you are taking a trade of $50 million, right? And the volume is barely 5 million, 10 million. So that sort of capital can move the market. It could move the market so much drastically, because once you punch in a trade of $10 million, it will soak up all the liquidity. The price of the stock will sharply increase by 3-4%, and then you punch in more orders, it will increase more, taking your average price, let's say, from 100 to 105 or $106. And this will be like non-returns for you, right? If your model is still assuming that you were able to enter at $100, it's a artificial gain, right? So now, overestimating execution speed, not entirely for people who are for retail traders, honestly. HFTs, every microsecond matters, every latency, everything matters, because they are working on statistical arbitrages and misquotations and mispricing between two exchanges, two liquid ETFs. Every microsecond matters, but your loop latency might be 50 milliseconds. You might be able to take down that loop latency to, let's say, 5 milliseconds with virtual private servers. This is the issue. Now, phase 4, risk management and live trading phase, correlation breakdown during crisis. This is a good topic, right? So, if you are thinking that your multi asset model has a basket of corporate bonds, equities, commodities, treasury bonds, and you're thinking for diversification and making it safe, holding equities and high yield corporate bonds is diversified and it's safe, it's not. When there are huge crashes and crises like 2008, 2020, both will crash together, and they will crash drastically. This will be a fat tail event, taking your portfolio into a huge drawdown. That's why in a lot of models we include cash only. When there is a crisis, that you go only in cash, or you take the treasury bill bonds or government bonds, which is basically risk free rate of return. They might provide you, or liquid funds, they might provide you with 0.1% return, but when the entire market is going down, you're still making 0.1. You're saving that money, man. You're saving that money, you're not going into drawdown. That's the best part, right? So as you can see, stocks might be showing low correlation throughout the time period, but all of a sudden during crisis they might be highly correlated and crash together. Now, Position sizing. I will be making an entire 5 to 10 minute video on Kelly criterion, going over the mathematical calculation and everything. But for now, Kelly criterion is the optimal percentage of risk you should take per trade to maximize your growth and avoid the risk of ruin. Basically, avoiding 100% drawdown or huge drawdowns of 50, 70, 80%. Right? For example, risking 20% of your trade per account on a strategist only wins 55% of time. This will definitely lead you to failure. Now, the Kelly criterion, as you can see, if you're betting, let's say, 2% per trade, if your Kelly criterion is, let's say, 5%, you are taking 5% per trade, it will lead to a, a smooth equity curve. It will lead to maximizing your growth without huge drawdowns. Whereas overbetting might lead to great returns, but could also absolutely ruin your portfolio. For example, I've entered a strategy. The Kelly criterion for that is about 7.5%. But me being a conservative trader, I don't want to lose my portfolio. I take about 4.5% risk per trade, making it a conservative Kelly, so that just in case if there is any slippage or any out of this world or impossible event happening, I'm still safe. Now, coming on to the last point, that is a leverage illusion. So, a low volatility fixed income strategy might look perfectly safe to make absolute returns like your government bonds. And while volatility of the underlying asset is low, tail events are magnified by leverage and completely wiping out the fund. For example, long term capital management in 1998 applying 25 to 1 leverage in tiny arbitrage spreads. Common mistake if you're thinking that if you're making 20% CAGR and you take 3x leverage, you will make insane amounts of money. You might, but it's not sustainable in the long run, guys. This is the illusion of safety with extreme leverage. Let's talk about 10th of October 2025, wherein Bitcoin was down, I think 20%, altcoins were down 40 to 70%, they were down, man. If you were into any of those altcoins, I'm not even saying with 100x leverage or 20, 25x leverage. I'm saying with barely 2x or 3x leverage. If you were in that trade in a long, you might have gotten liquidated because it went down by 50%. How will you survive that until unless you have enough margin, right? So this is illusion of safety with extreme leverage. This notebook will again be shared in the school and you can check it below. You can download it, watch the video side by side, keeping one window open for the Jupyter notebook, one window for the video. It helps me because I like to have my reference material directly in front of me. Your learning curve, your choice. So that will be all, guys, for today. Ted signing out. Bye bye, guys.